My name is David Aaron. Thanks for taking the time to watch this webinar. In this webinar, you're going to learn the 4 financial strategies for business owners on how to use your business to fund your personal financial goals. These 4 strategies are meant to spark a conversation about your own situation. They're by no means the only strategies used in achieving your goals. As a business owner, your planning needs are more complex as your personal financial goals are connected to how well you achieve your business goals. It makes sense to meet with an advisor who understands how your personal and business goals are connected. But what happens if your needs have outgrown your advisor's knowledge or product offering? Finding an advisor who understands your needs, has the necessary licenses, and is someone you feel comfortable sharing private, confidential information with, well, that's not easy. That's the purpose of this webinar, to provide a simple, creative method of introducing myself to you. After watching this webinar, I'm sure you're going to have questions. I encourage you to schedule a meeting with me to discuss your own personal situation and goals. So let's get started. Over the last 20 years, I've provided solutions to business owners, incorporated professionals, and high net worth families. About 70% of my clients are over the age of 50, 60% of them own private corporations, and 40% of my clients are high net worth families. I've also had the opportunity to pay it forward as a director of advisor development, hiring, coaching, and developing new and veteran advisors. Over the 20 years, I've transitioned my practice to specializing in working with business owners rather than being a generalist. A generalist takes on any client, whereas a specialist is considered an expert in their business. I think this slide best illustrates the mind of a business owner. Experts say we have more than 60,000 thoughts per day, and as a business owner, adding the responsibility of running that business, well, that just adds up those thoughts. It's easy to understand why those business owners might need expert advice, specialized knowledge, and a true understanding of generational wealth transfer. Which brings us to why you're here today. Every client goes through a planning process. This process ensures we are identifying your goals and understand what we are trying to achieve. Step 1 is our first meeting. This is where we're going to identify and prioritize your financial goals. Either at that meeting or in a second meeting, we'll begin to gather all of the relevant information. This is information that will help us to determine what kind of recommendation will be best for you. We'll analyze the information and then come back to you with 2 to 3 different recommendations. Why do we say 2 to 3? Because there isn't one path to get to where you want to go. Sometimes the paths are a little bit more aggressive, and we need to gauge just how much risk you're comfortable with. So by providing 2 to 3 different recommendations, that gives you a really good understanding about which path is most comfortable for you. Of course, the 5th step is you implementing those recommendations. It doesn't really help if you don't take our advice. The 6th step is periodic reviews. At a minimum, we meet twice a year with our clients, but of course, when we meet, well, that's entirely up to you. Okay, so let's get into the 4 strategies for business owners. Keep in mind there are many ways to help you. These are only 4 of the strategies. You may have heard of them before, but maybe you didn't get a complete explanation of how they work. After today, you should have a good understanding of how they might be beneficial to you. In fact, as I share this information with you, the most common reaction by business owners is, why aren't we doing this already? A quick disclaimer here. Only life insurance advisors are legally permitted to discuss these strategies. Strategy number 1, low-fee funds. That's right, you heard it right. I said low-fee funds, and you're looking at group retirement plans. Let me explain. This entire webinar is seen through the lens of a business owner. It's about taking advantage of the fact that you are a business owner and there are other options available to you. There's a lot of noise right now around low-fee funds. For those of you who don't know, mutual funds and segregated funds have embedded fees. Many companies offer low fees to larger deposits, somewhere between $250,000 to $500,000. An alternative is to start your own group plan through your business. These plans are often built with lower fees. Let me explain how. On the right is a fund prospectus. And by the way, this is not an example of a low-fee fund. I chose this on purpose. The MER, or the management expense ratio, your fee, is 2.91%, which is quite high. I picked it to demonstrate how you as a business owner can reduce the price of a retail-priced fund by simply opening a group plan. Now you have this fund available to you in your group plan at 0.5%, not 2.9%. And you don't need to have a threshold of $250,000 to $500,000 to get the lower pricing. There's no change in performance of the fund either. Rate of returns are usually on the second page. Actually, the fund prospectus is either 1 to 4 pages. I'm not going to show the entire prospectus, but it is worth just noting this second page. The rate of returns are listed in the middle of the page. They're actually quite attractive for this fund. What you have to do, though, is subtract out the cost of investing. Let's look at the inception date over there on the right. It says 13.1%. So since this fund has been available to people to invest, it has produced a 13.1%. Not bad, but what you would do is subtract the 2.91%, so that is the actual rate of return you would receive. However, in a group plan, you would only have to subtract 0.5%. You've just increased your rate of return by 2.4% simply by changing the type of account. You've also saved yourself 2.4% in fees. So on $100,000, that would be $2,400. The MER in a fund is only one way to measure or to compare one fund against another. Strategy number 2, segregated funds. This is an example of a segregated fund. And by the way, the MER of this fund is 2.17, noted right here with the circle. Why are segregated funds a useful tool for business owners? Well, let's have a look. Principal guaranteed. 75% to 100% of your principal investment is guaranteed if you hold your fund for a certain length of time, usually 10 years. Now, this was a significant advantage back in 2008 and 2009 during the worldwide financial crisis. Investors using segregated funds would have had their principal protected between 75% to 100%. It really depends on which level of protection you had on their account. This means that their portfolio would have been topped up to the original deposit, either 75% or 100%. Guaranteed death benefit. Depending on your contract, beneficiaries will receive 75% to 100% of your market balance tax-free when you die. This benefit by far is the most valuable to you. It guarantees your beneficiaries will not suffer due to a market downturn. Let's say a business owner just deposited $500,000 into a segregated fund. If there was a market correction of 15% and the business owner died, the beneficiaries would receive $500,000 tax-free and not the market value, which was $425,000. In a mutual fund, the beneficiaries would receive the funds after the estate was probated and tax was paid. In Ontario, it takes roughly 90 days to probate an estate. In this case, there is a 1.5% probate fee attached to that $425,000. That works out to about $6,400. So we'll have to subtract that from the $425,000. The executor is entitled to roughly 5% of the balance, which is about $20,000. Then tax is paid to Revenue Canada. Then all of the money can be distributed to the beneficiaries. A segregated fund bypasses the estate, so the money never goes to probate, no delays, no to fees. The entire balance is sent to the beneficiaries usually within 10 days of receiving the notice of death. Segregated funds are amazingly efficient. Potential creditor protection. This is a valuable feature for business owners. It adds another layer of protection from creditors. By far, this has to be my most favorite, most valued part of a segregated fund. If you're like me, privacy is important. A probated will is a public document, which means the general public can see how much money is given to your children and spouse at your passing. Segregated funds bypass your estate, keeping private how much money was given to the beneficiaries. Segregated funds are private, they avoid probate fees, and there are no delays. It's an immediate tax-free transfer to the beneficiaries. The business owner advantage. You know this already. Well, that has to be control. Businesses pay almost all of your expenses. They control your personal income, meaning you have the ability to fluctuate how much you want to pay yourself. And you're always looking for more deduction. Individual pension plans. This is by far one of the most amazing strategies available to business owners. Of course, the title says dramatically boost your retirement assets with tax-deductible contribution. So let's just have a look at these three top items here, and then we'll go through it in more detail. Increased savings, 65%. Retirement income from IPPs can be expected to be larger only because you can deposit more money to an IPP as compared to an RRSP. Tax advantages. Unlike the fees in your RRSP, all contributions, all fees for actuarials, accountants, financial management fees, these are all tax deductible to your corporation. Second, it reduces passive investment tax of 50% on corporate asset. Now, I'm not sure whether or not all business owners are aware that this rule has recently changed about passive income, but we're going to get into a little bit deeper detail about what does that mean to you. Strategic planning. If you think about what kind of investments are actually strategic planning, this has got to be at the top of the list. It's a proven tax advantage strategy to move money off of the corporate balance sheet to fund your own retirement. And of course, it's 100% creditor protected. Why is it so attractive and why now? Well, the new passive income rules for Canadian controlled corporations has changed. These new rules established that where passive income generated from corporately owned investments exceed $50,000 per year, then the company's ability to claim the small business deduction will be reduced by $5 for each dollar over the $50,000. At $150,000 of passive income, your entire SBD is eliminated, and a company is forced to pay at the general rate on all profits, which is going to be over 50%. For many small businesses, particularly professional corporations such as dentists and doctors, this new rule promises a significant tax increase. It's estimated that it would cost about an additional $80,000 to a business owner with this new passive income tax. An alternative, and we'll get into more detail about this, an alternative would be to use permanent life insurance. It can be used to avoid the gradual loss of the small business deduction. However, it's not tax deductible in the way that IPPs are. So the definition, by the way, income refers to active business income. Income that does not qualify as active business income. That includes investment income, so the money that you're investing inside of your corporation in a mutual fund, that would be one of the parts of income that doesn't qualify. So that would be subject to the larger tax. And then income from a corporation that derives income from property. So if you have many properties, homes, condos, which has been really favorable given the low interest environment, people have ended up buying a lot of condos and homes and apartment buildings through their own corporation. This too would also not qualify. So here are some of the IPP advantages. By no means do I think you should know all of these. I know that your accountant would be very interested in these particular advantages, but as I've already mentioned them in some of the other slides, but just know there's a lot of advantages here, and you may want to just take note of them or screenshot it, and that way you could bring it up with your accountant, or you could just ring me up and we can talk in more detail about it. Indexed average wages. There's a misconception that an IPP is only beneficial for high income earners. Normally you'll see this in literature of $151,000 or higher. This is totally not correct. Revenue Canada actually uses a different formula for calculating IPPs. They'll take your T4 income, and let's say in this example it's $60,000, and they multiply it by 1.83 to get the number that they'll use towards calculating your IPP. In this case, $109,000. That's why you're able to contribute more money to an IPP. Funding an IPP versus an RRSP. This is an illustration of when would be the optimal time for you to open an IPP. If you are younger than 38, that's that green star. If you are younger than 38, it might make sense mathematically to use an RRSP. That orange line represents the maximum RRSP contribution, which is $26,500. Prior to age 38, you'll see the orange line was higher than the gray line, which represents the IPP. If you were younger than 38, you could open an RRSP, take advantage of the higher deposit amount, and then when you're around 38 years old, switch it to an IPP where the IPP deposit amounts are much higher. Who is this for? Incorporated professionals, meaning if you're self-employed but not incorporated, then you don't qualify for an IPP. Only corporations who have T4 income qualify for an IPP. Secondly, having a corporation or the same corporation for a long time is preferable, although you can use multiple corporations in the calculation of your IPP. Lawyers and dentists are just an example of some businesses that tend to stay in the same business for a very long time. Succession planning, a parent selling the business to their children. An IPP can ensure that their retirement is funded prior to selling the business. Parents want to pass the business to the next generation without placing their retirement in jeopardy. What if you're selling a business that's not related to a family member? An IPP is a very tax-efficient tool to use prior to the sale of a business. It can create a large tax deduction for the business and lower the purchase price by making financing the business more affordable, either for a total stranger or for the children, of course. Let's walk through a couple examples. This example is a business owner age 64 with a spouse age 62 who is in the business, and they both paid a T4 income. They've had a corporation going back to 1991. They can use their past service. What does this mean? Similar to a teacher's pension, using the best 5 years or the last 5 years, except an IPP uses T4 income all the way back to 1991. We'll give you this form to fill in, or your accountant will fill in. If your corporation doesn't go back to 1991, that's no problem. Leave those years blank. But in any case, we populate the form, then we take that information and we hand it to our actuary. Our actuary returns to us and tells us this IPP, based on up to today, could be funded almost $2 million. Where does the funding come from? They transfer their RSPs into the IPP, which is roughly $954,000. Then their corporation transfers $1 million. This can be done all at once or strategically over 15 years. Transfer more when a higher tax deduction is necessary, and less when the business doesn't require higher tax deductions. That is the first step, to calculate how much your pension can be funded using the previous T4 income. Step 2, the actuary determines how much money can be transferred in each year going forward. In this case, the actuary has mentioned that $156,000 can be transferred into the IPP this year. This will produce a pension at age 65, about $128,000, almost $129,000 per year until they die. This table is a little busy, but I'll walk you through it. It's pretty easy to understand. It compares an IPP versus an RSP. The table actually outlines at each age the differences between the annual IPP contribution room and the RSP contribution room. It also shows the projected accumulation amounts in both the IPP and the RSP. This highlights how much more retirement assets will be accumulated over time in the IPP due to the past service funding, which I just explained previously. The IPP Advantage columns show the benefit of the IPP. So let's just take a little time and go through this. On the left-hand side is the year. Let's say it was started in 2018, and it runs down to obviously when they're retired. The next column says their age, starting at age 55 through to age 71. And the next column is how much T4 income they had in each year. Now, of course, this is just hypothetical because we're actually showing you different values so we can illustrate this out to you. But it begins at $80,000, so that's not high. In fact, this is a lower T4 income example. We move to the next column, which is the IPP column. On an $80,000 T4 income, this person can transfer $20,000. As you know, in the first step, they moved in their RSPs first, and that's why we have the $482,000. So if you go forward and just look at each year, year after year after year, you can see where we get to that $1 million at the bottom of the page. But what I want to share with you is just the differences. The IPP in the first year is a $20,000 deposit. On a $80,000 T4 income in the RSP column, it's only $14,400. So you can see you're already putting in more money in the IPP than the RSP. So if you look at those two columns and you just go down to the bottom, you'll notice the IPP is a total contribution of just over $1 million. That money grows to $2.5 million. Whereas in the RSP, a total contribution of just over $600,000, which grows to almost $1.5 million. So the advantage, the final column on the right hand side, is the IPP was able to contribute more than $400,000 than the RSP, and it grew more than $1 million. So the question really is, how would you like to retire with $1 million more? Obviously, it's not a fair question, right? You want to have the most money you can in retirement to fund your retirement and live a good lifestyle. Let's just look at another example. This is the higher T4 income, and in this case, the numbers are just much higher. Actually, this looks more like what a lot of people have said, where you have to earn more than $150,000 a year. Starting at on the left-hand side, $150,000, and it goes right to age 71. The IPP deposits on $150,000 is $35,500 as compared to the RSP in the next column of $26,200. All the way to the bottom, and look at the IPP, you see that the IPP deposited almost $2 million that value grew to $5 million. The RSP, in contrast, you could only deposit about $1.3 million, and it grew to $3.5 million. Higher incomes, it just means higher amounts in your IPP. You were able to deposit from your corporation. So keep in mind, this is transferring money off of your balance sheet in your corporation that would have been sitting there getting the higher tax rate of above 50%. You've moved it off the balance sheet into your personal pension plan, in this case, your individual pension plan, $653,000 more than you would have done in your RSP, and it grew an additional $1.5 million. So you have over your RSP, you have $5 million in your IPP as compared to $3.5 million in your RSP. Corporate asset transfer. This is the fourth strategy for business owners. This by far is probably one of the most flexible and easiest. When I say easiest type of strategy to use, I say it's easy because it's pretty straightforward in the sense that it's life insurance. So it's a person who is applying for life insurance just the way you would for mortgage insurance or your own personal insurance. It's pretty simple. You answer a few questions. Usually when you're depositing larger amounts of money in a life insurance policy, you may have to have some type of medical which is supplied by the insurance company. Corporate asset transfer is fairly straightforward. You're taking money off of your corporate balance sheet and depositing into life insurance which is owned by your corporation. Where the return comes from the life insurance company investing that money. Some of that money is invested in equities, about 20%, 20% in mortgages, about 50% in bonds, and about 10, 11% in private placement or cash. That's a fairly normal type of fluctuation in terms of the investment makeup or the allocation. And one company over the other, there might be slight variations. So let's have a look at how this works. I'm not going to go into the full detail about how this works. I just want to give you sort of the outcomes, if you will. When we meet, I'm going to go through every detail so you fully understand all of the bits and pieces of it, if you will. But let's have a look at how this works. This is a busy slide, but what we're going to do is we're just going to separate this. This is the left side shows a mutual fund and the right side shows the insurance. So imagine the left side is you having money in your corporation and you're investing in a mutual fund, and the right side would be investing inside of a participating life insurance policy. This only works well in a participating life insurance policy. If you try to do this in a universal life policy, you may have a completely different outcome, one that you're not very happy with. The reasons for that, there's a number of reasons. I can get into that during our one-on-one meeting, but just know that this only really works well with participating life insurance policies. So let's sort of get into how this works. In this example, you're using a mutual fund to invest your money within your corporation. You're depositing $1,000 a month for 20 years, which comes to $240,000. Let's say this mutual fund is earning 7% rate of return. That means that the money inside of this mutual fund is going to be taxable because it's not an RSP, it's not a tax-free savings account, it's a mutual fund. So tax would need to be taken from this mutual fund when you use the money. When you go to use the money, and let's say we attach another strategy or a goal to it, ideally when you're doing this kind of strategy, if you're examining should you use life insurance or mutual fund, you're trying to answer a question. I want to take the money, or it's actually two problems, right? I want to take the money off of the balance sheet because it's being taxed too heavily. So that's one reason to do this. The second is you want to use that money later on, probably at retirement. So we would go into a retirement discussion. When do you want to use the money? For how long do you want the money to last? And so in this example, let's just say that you're going to use the money at retirement for a period of 15 years. So your intention is to spend the entire amount of money over a 15-year period. Well, that means that that's about $36,000. When this investment grows, it'll allow you to withdraw $36,000 per year over a 15-year period, which is about $490,000. Then the person dies. So again, this is going back to that strategy of saying you have money today, you invest the money for the future, you use the money, and then death occurs. That is the sort of cycle of our lives. In this case, the person dies and they've done exactly what they wanted to do. use all the money prior to their passing and they've passed away, there's no money left in this mutual fund, no money going to their beneficiaries. Okay, let's look at the corporate asset transfer. This is using participating life insurance to move money off of your corporate balance sheet and into, it's basically a tax shelter, isn't it? $1,000 per month for 20 years is $240,000 deposited to the participating life insurance policy. The rules around life insurance cash values, there's no tax when it's held inside of the life insurance policy. That way you have compounding going on and the money is growing to a larger amount, more than the mutual fund would have. You end up using $550,000 over that 15-year period. Same thing as in the mutual fund. The timelines are exactly the same. We're not throwing a better advantage here in terms of time. You're using the money over a 15-year period, in this case $550,000. It works out to about $60,000 more, and then the person passes away. But it's life insurance, so there's a death benefit. $1.3 million goes to the beneficiaries at passing. So the first benefit is that you end up using more money over the 15-year period. The second is $1.3 million tax-free goes to the beneficiaries of the life insurance policy. I mean, given this situation, which strategy would you use? I know it's not a fair question, right? Now, I think you're probably wondering, this has to be too good to be true, but it's not. In fact, I have more for you. This is really cool. The internal rate of return, or let's say the dividend that is credited to the account, is about 5 to 6% per year. Current rates for loans are about 4%. After tax, say 2%. If you were to use this as collateral against a loan, it would cost you about after tax 2% per year, but you're making 5 to 6% inside of the life insurance. So the dividend that's being credited to the account is about 5 to 6%. It is a perfect loan for the bank. The loan is collateralized against the cash value. The cash value will not decrease because it's a dividend that's being credited to the account. It's not like in a mutual fund or in a universal life policy where the cash values can go up and down depending on how well the performance of the mutual fund. In a participating life insurance policy, once the dividend is credited to the account, that's your new balance. It doesn't go down from that unless you actually take a physical withdrawal of the cash. If and when the person passes away, the loan is paid off and the remaining amount of money is transferred to the beneficiaries of the corporation. But what if you don't use this money in the sense of taking a loan? What if you just leave it right there? Or what if you did end up taking it out? Because there's so many different advantages. If you did take the money out, it's tax-free to you. That means you don't experience a clawback of your old age security. Unlike if you were to have an RRSP and then a mutual fund in your corporation, this is all taxable income to you, which could affect your old age security entitlement. In this example, at age 70, the mutual fund had a cash value of $417,000 versus the life insurance $690,000. The death benefit at age 70 was $1.6 million. And just by the way, the death benefit at age 83, and I'm saying 83 because that is like a common age for people to pass away, was $2.4 million. So from $240,000 deposit to death benefit of $2.4 million. From an estate conservation and a generational wealth transfer point of view, this insurance strategy that increases the wealth by 10x. It's a powerful tool for you to consider. But again, it's not for everyone, and that's why in our meeting we go through each one of these different things. Not necessarily that this is the only thing we talk about, because you could just say, I want to open a tax-free savings account, or I'd like mortgage insurance. But these are some of the things we go through to figure out which strategy would be the best for you. So I just wanted to in closing, let you know that even as a business owner, you have your own personal needs. And there are things that are common to someone who is not a business owner that you would need to do, like retirement planning, or for families. Oftentimes I meet the adult children of business owners and I begin working with them to help them understand for saving for education, for instance. Investing in RSPs and tax-free savings accounts. Sometimes it's talking about paying down debt. Protecting a family with life insurance. Protecting incomes with disability insurance and critical illness insurance. These things are all common to business owners and the adult children of business owners. Again, I want to thank you for taking the time to watch this webinar today. Please put any comments you have or any questions if you want to share below, and I'll be happy to get back to you. And again, thank you again for taking time to watch this video.